Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have my friend Colm McEvilly. Colm began his career as a mechanical engineer, built a small single-family resident portfolio, then got into investor relations, where he has helped teams collectively raise $160 million. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz, and we'll start the conversation.
Thanks for joining us, Colm. Can you start by telling the listeners a little bit more about yourself and what you do?
Absolutely, Gary. Well, so you and I have known each other for a few years. I actually knew one of your past partners before who encouraged me to leave the W-2 and to go into these types of leveraged investments to create more passive income for myself. Background on myself, I've helped raise money for 19 projects. I've been involved in 24. I'm currently in 17. So I think 7 as an LP, maybe 10 as a GP. And I'm growing that, but the last couple of years have been very, very picky. And the purpose of the show today is to really help people understand that there's biases that can disrupt your decision as an investor. So that's one of the things that Gary asked me to talk about, because he knows that I've had about 6,000 investor calls, and he thinks it would be valuable for his active and passive investors to hear this information, because if you're an active investor and you're trying to raise money, understanding this information can help you when you're coaching or helping your investors make a decision. If you're a passive investor, this information can help provide clarity, which would reduce heartache and headache when you're deciding between multiple investment options.
Yeah. You have a very unique perspective, and everyone out there is trying to raise capital. And it's harder than ever right now. Just because of the media, and there's so much negative talk, but it's actually a really good buying opportunity. But I'm glad to have you and to really talk about the things that you've learned over the years. So talk about that investor decision-making process.
Yeah. So the investor decision-making process, like I said, is to reduce headache. It actually saves a lot of time too, because let's say you like 5 or 6 different syndicators and you haven't completely vetted all their sponsorships, but you're looking at different deals. Having an established process, and we'll talk about the 4 key quadrants or the 4 key steps that I help my investors go through. And if you want, you can set up a call with me. I'm pitchless. I'm not going to pitch you on a deal, and we can help create an investment decision process for you as well. But the process really helps you with being consistent with your decision. So if you don't have decision quality that's high, you're not going to have a life quality that's high. You're not going to have an investment quality that's high. And it's the correct decisions over time that's going to lead you to victory, or in our particular case, higher returns over the long run, which is what we want. And so when we talked, you and I met at the MFIN in San Francisco, and I was talking about how this investor was telling me about one of their favorite investments. And I asked him, was that your best decision? And he said, yeah, because it was the decision that made me the most money. And I thought about that, and I thought that right then and there was an example of results biases. And a results bias is something that can make you think that you made the right decision when really you got lucky with the result. And so it's a result bias is where people are judging the quality of their investment decision based on the results and not the actual methodology that they took to get to the decision to invest. So a perfect example was, are you a Giants fan because you're from New York?
I'm a Jets fan. I was born in Queens.
Oh, I'm sorry. Okay, so well, going to the East Coast a few years ago, Pete Carroll with the Seahawks was playing New England. So you probably don't like the Patties, but we're not going to get political here. But Pete Carroll made a call in the 2018 Super Bowl that on the 1 yard line with only a few minutes left in the Super Bowl to have the 1 yard throw, and it was intercepted by Malcolm Butler. And a lot of the news media called Pete Carroll a ding dong. Hey, you're a dingus. Why would you risk doing a throw when you had the best running back in the league? Well, it was a second down, and earlier in the entire season there was 0 1 yard interceptions. So statistically, Pete Carroll actually had opportunities to run the yard after, and he statistically made the right decision because there was 0 1 yard interceptions that entire season. Yet everybody judged his decision based on the result, not based on the quality. So he made a good decision, but it was just a bad result.
And I remember that play exactly. I mean, Malcolm
Butler, yeah.
He made a great play. He was coached very, very well, and he was coached to step in and get the ball. But that's for another day.
Yeah. So just remember that if you look back at your previous investments or your previous engagements in working with another, if you're an active investor, if you're working with another sponsor, don't judge that decision based on the result. Judge it based on the process that you made to join the team, how you did the vetting, and or how you did the decision to invest. So that's the first of the 3 biases that we're going to cover. So results biases. The second one, which is important to know, is every decision's a bet, and every decision you make has biases. Because let's say I'm trying to raise money, I need to understand that my investors are receiving information from other locations, and I can't change what information they receive, but I can change and help shape how they might receive that information. So if I'm trying to raise money, I need to understand that there's decision biases based on the information they have. Okay. If I'm trying to make a decision to invest, I need to understand that my decision is based on the information in front of me. Is it vetted, reliable information? Is it coming from the OM of the selling broker? And so this is an opportunity as a passive investor to ask the sponsor where they're getting this information. And I know there's a lot of sponsors out there that are super transparent, and they'll tell you as an investor that, hey, I got this information from the Costar report, or I got it from a third-party independent market study that we paid $10,000 to do. One of my previous companies I worked for, we would always do 2 independent market studies before we did an investment, because we'd rather spend $20,000 or $50,000 vetting it that way than lose $1 million of investors' money or something. So the second biases is decision biases. It's the information quality. And then the third bias that you need to be cognizant of is that there's confirmation biases. So Gary, what do you think a confirmation bias is based on the name confirmation bias? Confirmation.
Well, maybe you have a friend that has invested with that group before, and they'll say, "Hey, you should invest with them."
It could be. So building off of that, it's basically where people tend to interpret new information as a confirmation of their existing beliefs. So if my friend, and Gary, I don't think people know this, but Gary, you helped me out a few years ago. Not that it even matters, but you helped me out a few years ago on an investment. Really appreciate that. But talking to you as you were helping me source additional funds, you kind of confirmed that there was another guy that I should work with. And then when I talked to him and he said things that you said about the guy, that kind of confirmed these things I already heard from you. And so that's a confirmation bias. The guy could have been a complete crook, but he wasn't. So it was an investment out of San Antonio. But so confirmation biases, results biases, and decision biases are the 3 biases that impact your decision. So now you understand that, and you understand you need to vet the information, you need to vet yourself. Well, we need to create a process, and the process is going to put you in the driver's seat. And if you're trying to raise money, it's especially important to work with the investors to create that, because it provides clarity, it demystifies the process, and it gives the investors decision. It gives them control. And I think, Gary, because how many projects have you done in San Antonio, in Tucson? 9?
Yeah, we're raising capital on our 9th property in Tucson right now.
Okay, so actually, just jumping side note, I really appreciate and value the fact that you're hyper focused on one market, because it allows you to become an expert in a market. And so in this next section where we talk about some of the vetting processes, one of those things is the sponsor heavily involved in the same market over and over again, because that's how you can really understand, so many little details. So, but going back, you need to help your investors create a decision-making process, because it will give them control. And everybody knows that a confused investor is not going to make a decision. If you go into Baskin Robbins and they have 61 flavors, like, you're confused. But if they had 4 flavors, I know which of the 4, which of the 4 flavors are you getting, Gary?
There's only one flavor for me.
Which one?
Oreo.
Okay.
I love Oreo. I love it so much. My kids really wanted a dog, so they found a black and white dog and they named it Oreo so they can get the dog.
No. Oh, there's a little bit of a manipulation going on there.
Oh yeah.
That's funny. Was it black spots, or was it like kind of patchy all over?
Yeah, I'd say patchy, but we digress.
All right. Well, I'm gonna use that to manipulate you next time we partner together. So,
right.
but I'll just put like a spotted dog on the OM. So, so the key thing is helping your investors create a decision-making process is going to demystify it. It's going to allow them to make a decision. And then again, because every decision's a bet, you can help them create different levels of risk they associate with different parameters. So maybe they don't like one particular thing about an investment, but you can help them quantify, and this might not work with physician investors, but with technical investors, they'll really appreciate this. But you can help them quantify the level of degree that particular metric is acceptable for them, which is then related to risk, which is then related to how likely they are to move forward. So moving into the decision-making process, the decision quality is your decision, is your life quality. So it's your investment quality. And there's 4 key areas I like to focus on: the sponsor, the MSA in the area, the investment, and then the deal numbers. And the deal numbers are the last thing. And I don't know if you notice this, Gary, but when investors talk to me and they only talk about the numbers, what do you think when an investor asks you, hey, what's the returns on this? What do you think?
They're chasing IRR, and I'm never going to please that investor, because our numbers are conservative. We want solid, safe investments, and so there's always going to be someone that's going to offer a deal with higher IRR than us, but we're going to minimize the downside risk. They probably aren't. We're going to beat our pro forma most months. They probably aren't. They're shooting for this moon. We're shooting for protecting our investor capital first, and then having very strong returns.
Yeah. And building on that, the investors going to the returns, which is just an estimate, and they're skipping the strategy. They're skipping the lending information. They're skipping the local laws, the municipalities. They're not even asking about how many developments or permits are going in the area. And so the purpose of helping, and you could even do a webinar on this, helping them create this process is so that they like a submarine, they have to fill up each of the components of the submarine before they move to the next. And the very last thing is the numbers. So the first thing is the first of the 4 is sponsors. So I always recommend that they have a phone call. I recommend that they do a track record. They ask for referrals. I'm in a bunch of investments, and I would probably be a very annoying investor, but I'm going to ask for referrals I'm gonna, because it's my money and it's there to invest and build wealth for my family. I have to protect this. And then I'm going to ask for their high level strategy, and does that align with what I want? I actually like really long holds. I don't know if you're doing that, Gary. It
We
depends.
we aim to maximize IRR, so we
Mhm.
typically don't do long holds. We're in the process of our longest hold right now. We've had a property for a little over 2 years. We are financing it right now, and returning over 100% of capital to our investors because it's just not a good time to sell.
Mhm.
We've locked in really good gains for our investors because of the speed of execution on our business plan. But this deal will probably be, 4.5, 5 years, based on, timing of sale.
The market. Well, so what I'm hearing is you probably time your holding and you align it as the velocity of your NOI improvements decreases. Because once you do all the capexes, once you do all the renovations, you can only add rent so much, and so that's probably when you look to just get some whisper prices and stuff like that.
Yeah.
So
If the market is agreeing with us, if it's not, then
yeah.
we'll wait to a more opportune time.
Yeah, and I think that's absolutely the best. That's the best strategy to maximize that IRR. Me personally, I probably have 13K ones this year. So I think about, because I like longer holds. Maybe I'm not going to get the highest return, but I think about, okay, I got to redeploy my money to get the depreciation again. So that's an example of I'm vetting the strategy of the sponsor versus what I want. Maybe I just want to be a lazy bum and play soccer every evening instead of looking for money to redeploy. So that's why I like longer holds. But as an investor, you need to understand that, you work with Gary, you're going to get probably a shorter hold with a higher return. I kind of like it easy. I just be a checkbook investor. So and I'll recap. So with a sponsor, you want to get a phone call. You really want to understand their track record. You want to get referrals. You want to understand their strategy if it aligns with you. And then you want to ask them about their partners, because the people that they choose to do business with in the past will probably be similar to the people that they choose to do business with in the future and during the hold of your investment. So those are the four areas, or those are the few areas that I coach my investors to get information on in regards to the sponsor. Now I feel comfortable with the sponsor. Would you feel comfortable with the sponsor, Gary? If you did that, would you be pretty comfortable?
Yeah, absolutely.
Yeah.
For me, I agree with you. That's the most important thing. You've got to bet on the jockey.
Yeah.
You can't bet on the deal because there's so many other factors like we talked about.
Yeah, I'm looking for your book. I know it's a red one. I think your book's actually in my living room because I was reading it. And but the point is, talking about the jockey, asset management is probably the most underappreciated component. You could raise money. There's actually an investment one time where we closed, and the investors were all excited and stuff. And the investor asked me why I wasn't super excited, and I said, well, I'm surely I'm excited that we closed and everything, but this is when the real work begins. This is when the slow grind begins. And so I think they got it. And because at the end of the project, it was an absolute home run. We secured municipality rebates on it as well. But the key thing is your jockey is ultra important. A good asset management partner can keep a property afloat even if there's really bad times. So that's the sponsorship portion. So that's the first thing. The second thing is the MSA in the area. So I like to start with market KPIs and then sub-market KPIs. So I came from Grow Capitus with Neil Bawa. I drank the Kool-Aid on location magic. If you don't know what that is, essentially it's 5 key components of a city, of a metro, 5 key components of a neighborhood. I stick to those. Those KPIs have changed, but essentially it has to do with average condo value for an area, the average income for an area, the crime rate for an area, the poverty rate. What else is there? The average, I said income. Oh, the population growth. So there's like five things. The last one's job growth, and if you look at it as a pie chart for a metro, and there's 5 pieces, we would probably say that the job growth is the biggest driver. That's probably 40% of the pie. And then the population growth, income growth, average condo value growth, and the crime decrease, those are probably 15% slices of the pie. So that's how I would judge a metro, because I want to create something with a tailwind. So I look at Tucson, and they have a lot of population growth. They have a lot of job growth. I've never directly invested in Tucson, so I don't know the other information, but as a high level, when I'm looking at Yardi Matrix reports, I see Tucson's constantly doing well. So you chose your horse to ride with. So let's assume that metro checks the box. Now I'm going to look into the neighborhood, which is a submarket KPI. And you can get that information from Costar report, citydata.com, Neighborhood Scout, greatschools.org. There's a few different, there's probably like 7 or 8 different websites that I use as a really pedantic investor. But with the neighborhood, I'm looking at the poverty rate versus the rest of the area. I'm looking at the rent rates for the area, and I'm looking at, again, crime. I'm looking at the school scores. If I'm investing in a class B investment, I know that the school scores are probably more important than a class C investment, where it's probably more of the safety. Do you know what I mean, Gary?
Absolutely.
Yeah.
We haven't on some of our properties yet. We haven't had to really, we haven't worried too much on the school scores, and we've done phenomenally well. But yeah, when you're looking at the nicer properties and your higher rent, then that's something that you have to do. I mean, you always want a nice school there, but it's not always something that you can get.
Yeah. So another thing that is in the MSA decision making, I'll call it a column, is the laws and the risks, because the laws are relative to your investment because it affects the risks. I'm in 2 different investments in Georgia, and people sometimes they tend to group rent control state by state, but it's county by county. There's an investment in DeKalb County, which is it's like southeast of Atlanta, and I'll never do an investment there. It took 6 to 8 months to get people out. Whereas up in northern Georgia, Dalton, Georgia, the carpet factory of the world, we could get people out in 3 days. So just know that you need to know the local laws, how it pertains, and it's an opportunity for you as an investor to ask your sponsor. Then you can really see if they understand the laws. Gary's going to know Tucson because he's there all the time, right? So, but if you have a sponsor that's doing projects in different parts of the country, it's extra important for you to ask that question about the rent control, about maybe eviction timeline, about do they know the city, or who of their property management team is intimately familiar with certain laws that are going to affect maybe like cleanup. And I'm forgetting the term right now, but there's a term where if something, vector control, I don't know if they have that. It's probably too hot in Tucson to have that, but if there's pests and stuff, you need to know that. So the laws, the municipality, another MSA checkbox is I want to know how many permits and developments on the area. If I'm doing an investment and there's a certain amount of developments within a comparable area within the local market, I know that I have to be aware that we might have to drop rent a couple or do a few months of free rent just to get people in. That's going to hurt the cash flow. If maybe I don't want to invest in something like that. The unit count, the square footage, are all the units in this particular property big for the area? That's important, because if I'm looking at different places to live as a tenant, I'm naturally going to choose the bigger place. It's going to feel less cramped, unless there's a bunch of walls in there. And the open floor plans. I know, Gary, you just remodeled like 60 units on one of your properties. On a bunch of properties, but when you remodeled it, did you open the floor plans anyway, or
not really? We typically don't. Sometimes from the kitchen to the living area, there might be some cabinets that we can either take out or make it see through, and that just having it being able to like see through it versus closed opens it up quite a lot. So, but we don't do too much on changing walls and stuff like that as far as in apartments.
Yeah, I like that. I just did that to my kitchen because I was able to I was able to reinforce it without doing full structural. So it really opened it up. So, the last thing is asset class. I don't know if do you know what type of asset class you typically choose? I know the type that I like, and I know that there's risk associated with each asset class. Typically, you're going to have maybe a little bit more cash flow on Class C, but it's a lot more work. So because it's more work, it's more risk. Cash B is kind of a good balance. Class B is kind of a good balance. The argument is that you get a Class B in a Class A area, and it moves up to Class A. It depends on it goes back to asset management and property management. And then also knowing Class A, if there's a recession, Class A typically hits the hardest, but usually they recover the soonest. So there's a balance of risks that you need to be aware of, and you need to write down what you're comfortable with, because this information could be overwhelming if you don't know exactly what you're comfortable with right away. Again, this is about making a decision quickly, or empowering you to make a decision quickly, because you already made your decisions before in this decision-making in this decision-making process. So you have the sponsor, the MSA. Now we're moving to the investment. This is a third of the fourth. And again, you could set up a call with me, and we can create a decision-making process with you pitchless. The third is the investment. So right off the top, tax benefits. People are either cash flow investors, equity investors, appreciation investors, or they're tax deferral investors. So what's the tax benefits? What's the NOI? What's the lending information? What's the LTV, the LTC? What's the distribution schedule? A lot of people have been going month to month or monthly. Is that something you want? I don't really care. Personally, I have enough investments to where if I get a quarterly check, I don't really care. But and then the last thing is look at formsd.com filing. Just make sure that the person you're working with is a real entity. So that's the investment column for the decision-making process. And then the fourth and the final is the deal numbers. So the CapEx, the reserves, the ops, the fees, understanding what's the range that you feel comfortable with for an investment so that you can move forward. And then ask for the underwriting. And you don't have to get the actual Excel spreadsheet. Ask for a screenshot of it. I don't know if you'd hate me for saying this, Gary, but I always do. Ask for a screenshot of the underwriting. If they don't want to share that, I personally wouldn't invest with somebody if they didn't want to share that, because they should be confident. If anything, them sharing the underwriting is an argument supporting the fact that they believe in the deal. Ask for the performance.
We would share a screenshot, but we wouldn't share our model. I mean, the model we spent well over $10,000 developing and whatnot.
100%.
So that's part of our secret sauce. But we would be able to walk them through or share a screenshot of it.
Well, and yeah, building off that, I actually wouldn't share the model either. I would share a screenshot, and I would probably record a video walking through it, or we could do a one-on-one Zoom call with an investor. But the reason I wouldn't want to share the screenshot is I actually this was probably 2019. I was sending out a couple models, and the version of Google spreadsheets, or not Google, it wasn't Google spreadsheets. The version of Excel that the investor had was different than the version we had. So when they opened up the model, some of the VBA coding and some of the macros didn't transfer over. So I got this call from a guy asking me about these numbers. And at this point, I probably sent it to like 60 investors, but only one of them called me. Yeah. So the point is, the sponsor should share a screenshot. They shouldn't share the actual model, because there could be a drop in the translation. There could be a drop in the something could go wrong in how you open the interface. You just want a PDF of it, and then you could ask questions. If you're an active investor or if you're raising money, it's an excuse to touch your investors and have a conversation. So I highly encourage you to share the model. You want to look at the comps, and also, and this is something you might not be able to get, but the two last things are ask for the Costar reports and ask for sensitivity analysis. The lease up rate, the cap rate, the IRR, the occupancy, those should probably be in the underwriting.
but you should ask for that. So ask for the Costar report, ask for the underwriting. Those are probably the two biggest things with the deal numbers. So I'm just going to recap. When you're creating this decision-making process, you have the sponsor, the MSA, the investment, and then the deal number. That's how I help my investors.
Nice. This was a ton of good information for people looking to raise capital or invest in deals. Thank you so much, Colm, for coming on our show and adding a ton of value. Where can people connect with you?
So right now, I would recommend reaching out, just emailing me at colm@tgaip.com, and we could set up a call. And again, I'm not going to pitch you on any deal. And we can create an investment decision-making process specific to your needs. There's a lot of considerations that go into it. But again, the email is colm@tgaip.com.
Awesome. Well, this is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.